PayPal is currently down a whopping 77% from its all-time highs. Does that create massive opportunity for us as investors, or is this just a value trap? If you invested your hard-earned money in PayPal 5 years ago, you would be down 20%. Imagine investing and being patient as a long-term investor, and after 5 years you are still down 20%. That can't be a good feeling. A lot of people have been piling their money into this company, saying that it is currently undervalued, and that is what this video is going to be about. I want to see if this is a company that I will be willing to invest my money in, and if I do, I would tell you guys so that you can analyze the stock yourself. With that said, I want you to let me know down in the comments if there's another company that you would like me to analyze, whether it's a local or international company. And if you like this video, please give it a thumbs up and hit the notification bell icon so that you can be notified when I post videos similar to this. With that said, let's jump straight into it. So for those who don't know, PayPal is an online payment platform that facilitates payments between individuals and businesses. And what I always like to do is to go to the company's website and download their latest report. It's always a good idea to actually go onto their website, scroll through everything. They have a lot of news and articles and obviously previous and historical reports that you can monitor and go through. So this is basically the latest investor update from PayPal. Here we can see a couple of things that's really important, like the revenue of 7.4 billion or 7.04 billion, growing around 8.6%. So their revenue is growing quite a bit. 8.6% is really not bad. I would like to see double-digit growth, especially with payment companies. When I scroll down, we can see a summary of everything over here, and something that I noticed here is that the free cash flow decreased by around 3%, which is obviously not a good sign. They had a total of $5.1 billion in free cash flow on a trailing 12-month basis. When we scroll down, we can see that they have this compound annual growth rate report where they show the active accounts, total payment volumes, net revenue, non-GAAP EPS, and free cash flow. So obviously these are quite important metrics, and we can see here that basically over a time period of 5 years, it has been growing with double digits. And this is important for us to see as long-term investors. But really, this is quite interesting because although it has been growing with double digits over the last 5 years, the stock is down quite tremendously. So next, I'm going to jump to stock unlock and I'm going to select PayPal holdings. If we look at the 5-year graph, we can see how much this stock has dropped. And it reached a all-time high in around 2021. So there's a couple of things that we need to look at when we analyze a company like PayPal. So I'm going to click on Insights again. We can see here that they have grown their revenue around 8.73%, like we saw in the latest report. And we can see that it has a free cash flow margin of 18%, which suggests that the company is very profitable. So it means that the company is actually growing its free cash flow, which is from the get-go a good sign. It has a rating of 3.06 out of 5. And if we have a look at the financial health, the current ratio is above 1, which is good or average. And another thing that we can see is that the shares are decreasing. So that just gives us shareholder value. So that's a good sign as well. Something that's bothering me is the growth of the company. Like I said, we can see the revenue growth of 8.7%. The gross profit is not increasing. Operating income is increasing with 12.31%, which is good, but its net income is decreasing with a massive 24.46%, as well as its operating cash flow which is decreasing at minus 1.43%. So it has a bit of an issue with the bottom line, it seems. And this is the stuff that I like to look at, because that can determine whether it would be a good investment or not. So when we go to the income statement and we click on the yearly option, we can see that the total revenue has been growing steadily. So it means that the company is actually growing its business and its sales is increasing. This is a good sign for us, because we want to see that the company is growing and we want to see a steady track record. So this is one thing that I noticed, is that since around 2012, they have been growing tremendously, and it's really quite impressive to see this. When we look at the yearly operating income, we can see that the last year it has been going down, and this is something that is not a good sign. If we click on the quarterly option and we look at the operating income, we can see that it is down from quarter to quarter as well. And when we look at the net income of the company, we can see that yearly from the previous year, it's almost half, which is not great. It's not great at all. And this is something that we'll have to monitor with the latest earnings release, so that we can see if this is actually improving or not. And this is important. Do not decide with only the information that you see in front of you at the moment, but to monitor a company as it releases its latest earnings. When we go to the balance sheet, the company has a lot of cash on hand, and that has been growing from the last year. It has peaked in around 2020 with a massive $13 billion in total cash. It has a pretty good current ratio of above 1, so that's quite good. And I always look for companies that has enough cash to pay down all of its short-term debt or its current liabilities. And we can see they have $10 billion in cash, and their current liabilities is $45 billion. So they don't have enough cash to pay down all of their current liabilities. Although this is not something that a company will do, but it's good to know that they can do that. Something else that we need to look at is shareholder equity again, and this has been decreasing from the last year. And this is something that basically means that the value for us as investors is actually decreasing, which is not a good sign. Although its retained earnings has been growing tremendously over the last couple of years, which is again a good sign. And then my favorite statement, which is the cash flow statement, we can see that cash from operating activities is down. And this again is the way the business generates money is from its operations. So this is what the company does. That's how they generate money. So if that is down, it means that the company is either struggling or they have some internal issues. Some of the issues that PayPal has been struggling with is rising cost. PayPal has been facing rising costs in recent quarters due to factors such as increased marketing expenses and higher employee compensation. Another thing is weaker e-commerce growth. So PayPal's e-commerce business has been facing weaker growth in the recent quarters as consumers have actually begun to return to in-person shopping because of COVID that's no longer there. Increased competition is another challenge for PayPal, as well as recession fears. So PayPal's stock price has been declining in recent months as investors have become concerned about the possibility of a recession. And this has also led to a decline in PayPal's net income. So it is really based on how the consumers actually spend their money. So it's quite cyclical, I almost want to say. When we scroll down, we can see that the free cash flow is quite healthy still. If we look at the quarterly results, we can see that the cash flow is still growing from the last year, or basically it's flat. So it's barely growing. But if we look at the yearly result, we can see that that is down. So they still have a lot of cash flow or free cash flow, but this is decreasing, and it's not, we don't want to see margins get squeezed and free cash flow decreasing. What we can do is we can open the freeform tool, and the reason why I like PayPal is because of its how it's trading relative to its price to free cash flow. So if we have a look at the low and the average price to free cash flow that PayPal has been trading at, we can see that it reached a low of 13.56 with an average of 35 times price to free cash flow and a high of 72. So currently PayPal is trading at 15.57, which is very close to its low, and it's well below its average price to free cash flow. So this can indicate that the stock can be undervalued at the moment because it's trading lower relative to its average of 35 price to free cash flow. The reason why I'm not completely sold about the company is because I feel that there's another company that I would rather invest in. I made a video about this before, and it is Visa. Visa is a bigger business which is more established, and I personally have more trust in Visa. What I'm going to do is just show you quickly the revenue of both of the companies over a yearly basis, or let's make it a trailing 12-month basis. We can see that both PayPal and Visa made around the same amount of revenue. PayPal with 28 billion and Visa with 30.98 billion. So they're very close when it comes to revenue. But what I like about Visa is the fact that it brings a lot more money home to the bottom line. When we click on net income, the blue one is Visa and the green one is PayPal. So for the same amount of revenue or similar amounts of revenue, Visa almost makes 6 times more net income than PayPal does. And it's basically in the same kind of industry. Obviously, Visa is a much larger company, but still they generate similar amounts of revenue, but Visa brings home a lot more money to the bottom line. And that is definitely something that I like to see. One last thing that I wanted to show you on the freeform tool is retained earnings. So we can see that PayPal really retains a big amount of their earnings, beating Visa actually at around $19.75 billion versus Visa's $17.61 billion. So PayPal is definitely a solid company with good earnings, with good margins, with the possibility to retain a lot of their earnings, but they have quite a lot of challenges facing the company at the moment. If we click on the discounted cash flow model, if we use a projection of 5 years, we have to determine what the metric growth rate or the free cash flow growth rate will be over this 5 years. And what I've done is I've asked Google Bard what the free cash flow growth rate for for PayPal will be, and it's expected to grow at an average annual rate of 17.2%. So let's use that and have a look what it does. So let's say over the next 5 years, they will be able to grow at 17%. We'll use a price ratio of 20, which it's currently trading at. So we can see here that there's some really good upside for PayPal with a fair value of around $130, which is an upside of 81.35%, or over the next 5 years, a compound annual growth rate of 23.91%. So there's definitely some upside for PayPal. Whether this is going to happen in the short term, I am not sure. I am not sure whether they will be able to execute a 17% free cash flow growth rate. Let's change this back and make it half. Let's say they're able to grow it 8.5%. It's still below its fair value, but it reduces the compound annual growth rate quite tremendously. But still, this is a pretty good deal if you ask me. So I will be monitoring PayPal with its latest release, and I will see whether this is actually a company that I would invest my money in. From all of the companies that I've analyzed, I really like what they are doing. I think that there's a couple of things that needs to happen first, and they need to fix a few things, and we have to look at the growth forecasts. With that said, I really do hope that this can help you in some way. If it did, give it a thumbs up, and I'll see you guys in the next video.